recognize because it's a kind of, in most cases, they enter into a multi-element contract. It includes a lot of things. Number one, software, then software upgrades. Then there are various other attributes that are included as a part of the deal. So some are recognized as revenue, some are recognized as deferred revenue for which the company will provide the upgrades in the future. When they provide, then they recognize it. So you'll see over a period of time, the Microsoft deferred revenue is in trend. That means it's doing a pretty good business, you know, it's a future revenue growth is pretty solid, okay? Which is, we all know it's very solid, right? So this is the thing. Now, for example, credit card will record cash received from gift card sale as a deferred revenue. Not only credit card, if you go to any retailer, if you buy Amazon gift card, right? So Amazon gift card, so that's a deferred revenue from Amazon for the time being. So you will see that the Amazon's balance sheet, if you look at their balance sheet, you will see the deferred revenue is one of the important liability items for them. Then the expense must be recognized in the same period as revenue to which the realized, regardless of cash received and cash payment and related payments, or cash payment before the expense is incurred. That means, like deferred revenue, the company also pays in advance of expense, right? In advance. So here is three situation again. So the first situation is the expense paid in advance. For example, you are in accounts, then it will significantly understate the wage expense in the income statement, right? So if you don't consider, say, $50,000 wage expense of your business at the end of the year, though the payment will take place maybe 3 days later on the date, on the specific date, but you have to account for the wage up to December 31st. For example, if this is the end of the fiscal period, otherwise it will significantly understate the wage expense, right? So you create a lag, wage expense rate, wage expense, and then when the wages are paid later, then that liability will be gone. So this is the way. So the basic thing is the revenue recognition and expense recognition principle based on earned and incurred criteria, irrespective of the timing of cash receivable. Okay, so that's the whole principle here, based on which this financial accounting system works. And because of that, you will see a clear divergence between net earnings reported and the cash flows. Okay, you understand? All right, what's the time? Now, because of this accrual basis accounting, we have to expand our accounting equation. Don't talk. We have to expand our accounting equation as we go, right? The stockholders' equity part has been expanded to easy to understand things, right? Contributed capital, retained earnings, which is impacted by two things, revenues and expense, right? So you know that, right? By this time, revenues and expense, because the net result goes to retained earnings. So we keep these things separate because when we look at the transactions, we can very nicely classify them and record them in the spreadsheet, right? So now let us look at this carefully. In September, credit card, again, now let me see this thing, okay? In 2 here, this is all based on, this is the classified balance sheet, you saw that, it's all based on balance sheet information, right? Balance sheet, asset liability and stockholder security. Those items have been impacted because as a result of the items that we consider, right? So let's keep it that way. And then we are considering some income statement items or some operating activities, the summary of the effect of which, or the financial effect of which will be reflected in the captured and recorded in the income statement. So how we can do that? As you see here, these are all kind of relating to income statement situation. Really proud sold $15,000 apparel in the store and online. In-store customers paid with cash, right? Or debit or credit cards and settled as cash. So this is a cash sell. Simple thing, cash sell. So this cash comes from our previous example, $26,200. Okay, that's a continuation. So if you look at this is 26,200. You see that? So this is a continuation of this situation with the next stage. So, and then from this journal entry, respectively, we post. It's called posting process. Posting. Okay. Posting to the individual accounts. We call it T accounts. T. It looks like T, right? This. So simple. Always there here in this, in this part of the world, one thing is very sure, that it looks like a very, very simplified thing. Okay? I wish you see that kind of simplified thing when you are student in India, back in India. I'm a chartered accountant from India, actually. Okay? So, we made the thing so difficult sometimes. And when I came over here, I said, oh my goodness, this is so beautiful, so nice, so easy to understand. There are a lot of thinking process. When you see the product, we'll say, oh, how easy they are. But it's very difficult to develop that kind of process. Okay? And when we see the output, we see, oh, this is very simple. So it's difficult to make it simplified. The process underlying this thing is not easy. So that's my problem. So here we see this thing. Then they issue gift card. Gift card is a deferred revenue, as I said, right? So the $300 comes in and deferred revenue account, and we create another account, $300. Okay? Then it delivers $500 of apparel to a university organization billing its customer. Cash didn't come right away, so just bill the customer $500. Accounts receivable, sales revenue. This is quite understandable, and we make the necessary payment, right? And posting the accounts. As you see here, the sales 15,500. Any question? No? Okay. Then the company receives cash, $300 from the university organization. The university paid off the dues, $300. So, right? Then it wrote checks to employees totaling $8,700 for wages. For wages, it was expense, cash, $8,700, right? So, okay. Then he pays rent, right? As I said, like you in an apartment, you pay rent, right? So prepaid rent. And at the end of each month, 1/3 of that will be adjusted. 1/3. That adjustment, we will talk about that adjustment in the next chapter. Actually, as I said, the 1 and 2 is one chapter, 3 and 4 is another chapter. Okay, so what they segregate, try to oversimplify the whole process. Well, that's fine with me. So September 1st, they paid $7,200 in accounts. Prepaid rent, as you see here. Prepaid rent. The adjustment is on the same side of the accounting equation, offsetting entry, right? Offsetting. Each other. Then they wrote a check of $1,600 for office supplies, paper products, and fabric. This is supplies, right? So the business needs supplies to run the business. So again, supplies. It's an inventory. It's not an expense yet. It's an inventory. Goes to inventory, right? So that one classification of inventory is supplies. Okay, so cash goes out and supplies account is created. And then Prairie Frog received a bill of $400 for running a newspaper ad. Right? Newspaper. So again, this is the bill. Okay, and the newspaper ad in September, the bill will be paid on. So the ad was run in September. The bill was paid in October, will be paid in October, so the end of September, what we pay. So it's an accounts payable, right? You can use the term advertisement expense payable or advertisement payable as well. Okay? You have to properly name or provide a proper title to a payable account. Okay? All right? Then the company received and paid bills totaling $600 for September utility sales. They received and paid, right? So utilities expense, so the cash transaction. So after doing all this, they summarize all the accounts. It's a continuation of some of the accounts like cash, right? We see that. So it's a continuation, but some accounts are created this way. So we balance the accounts. As you see, the balancing is which side is higher, right? So you write the balance that way. Because cash, you see, your cash account 23,700 is the balance. Right? This way, supplies, it's the asset account, accounts receivable asset account, prepaid rent asset account, equipment asset account, logo asset account, right? Liability, deferred revenue, accounts payable, books payable, these are all liability accounts, these are the expense accounts, you see that? Expense, asset, these are all debit accounts, right? So debit accounts. Okay, revenue, part of stockholders' equity, revenue, liability, and other stockholders' equity items, these are all credits. Okay, these are all credits. You see here, sales revenue 15,500 credit, wages expense, utilities expense, advertising expense. We have a contributed capital at the beginning, there is no other contributed capital taking place here during the year. And retained earnings, we don't know anything about it because the company has just started its business. Okay? Once we are done with this, then from this we prepare a trial balance, right? From the individual accounts, balances we properly record under debit and credits column to see check the equality. And we call it our adjusted trial balance because it's not yet complete. There are certain adjustments that we need to make at the end of this accounting period. Okay, so this unadjusted trial balance, which is built on this one, so on this end, right? So it's a continuation.
Sorry, question. On slide 21, as the summary of the Latin American, under the sales revenue, we have to bring on, and that's under the shareholders equity. We have the sales revenue minus shareholders equity. So, this is my understanding of the first chapter, where we have the income statement. Yes, yes. This is my understanding of the first chapter. The income statement, we have the sales revenue and then expenses. So I know that the sales revenue comes under adjustment. So why do we have this under the shareholders equity now? Why do we have this sales revenue under shareholders equity? Just need to understand.
Your question is, why we have sales revenue
Yeah.
and we like stockholders' equity? Because what is the function of sales revenue? Where that income is go. Okay, so that's. Understand? Any other question? I think she is reading this thing very carefully. But I don't know whether you are reading this thing. Because when I'm describing, some of you went outside to get some fresh air. Right? I don't know how much air is available in the basement. Anyway. So do you understand this process? Right? You understand this process. So after that, this is the trial balance, though unadjusted, though incomplete up to this point, where we can see still without the adjustment income. Without adjustment. As I mentioned, when we have a deferred revenue, and after that, when the revenue is earned, that revenue earning process is complete, and then against the deferred revenue we make the adjustment. When we have expense, which is not yet paid, it means outstanding at the end of the year, we make certain adjustments. That's called the adjustment ratio, right? We incorporate the expense, we write the expense to that particular account, and we create a liability account. That's called the adjustment. So all these type of adjustments we take this later. Now, when the revenue is earned, but simultaneously the company didn't receive the payment, okay? So that's the kind of accounts receivable the company expects that revenue will be paid by the customer within a shorter time period. So you create an accounts receivable. So that's called an adjustment. So all those adjustments are needed to complete the entire thing. Otherwise, this income statement, if we run an income statement based on 15,500 revenue and the 3 expense item, which is the utilities and advertising expense, that's incomplete. That's wrong, right? That's wrong. So we need to know some more information. So that for which we need to do that. So here, review of revenue, review of expense. Okay, those 3 scenarios, when paid in advance, right? When the expenses are simultaneously paid, and when the expenses are paid later. Similarly, revenue received in advance, when the revenue and expense, revenue and cash received take place simultaneously, and when the revenue is received later. Right? So these are the 3 scenarios in each case, revenue and expense. So when we talk about income statement, we can calculate many different ratios to understand the profitability of a company. Okay? There are many different ratios. So for a starter, you need to know one ratio which we call it profit margin. Okay, how much profit is generated from each dollar of sales? It's a very simple ratio, net income over net sales. That's the ratio. Okay. Now, as you know, we also saw one ratio, and moving forward, we'll see some more ratios as well. But always remember that the ratio in isolation doesn't mean anything. Doesn't mean anything. Suppose I say the profit margin ratio is 22%. Means the company is generating, business is generating 22 cents per dollar of sales. Then I will ask you, is it good? You said, yeah, it is good in the sense that the income is positive. However, if you search for a little bit more and compare the company's own performance for the previous, say, 3 or 4 periods, 3 or 4 years, for example, you'll see that monotonically the profit margin has been declining. Has been declining monotonically. Say from 35 cents to now it's 22 cents, then you will come to realize that well, something is wrong here. So let me go deeper into it. You understand what I'm trying to say? Let me go deeper into it. Or if I compare the company's performance with those competitors, you'll see that those competitors generates a net profit margin which is about 38 cents per dollar versus the company's own margin is 22 cents. Then also you start thinking something wrong. Or if I look at the industry average in which the companies are part, and the industry average is say 30 cents per dollar, but the company's ratio is 22 cents. Does it ring a bell? Of course, and I will become more concerned. So the purpose of giving all these examples is this, that we need a benchmark, right? For each ratio, we need a benchmark to evaluate the company's performance. It could be the company's own performance over time, where longitudinal basis or a time-series basis we can compare, or we can compare the company's performance with its close competitor, or we can look at the industry average, right? So without those benchmark and a ratio in the isolation doesn't mean anything. Right? We need benchmark. What's the time now? Okay, let me take a look at some of this. 7. So please do that right up to development balance sheets. Okay. It's a goodbye grass corporation. Again, that's also a continuation. Okay, please don't talk. Okay? If you talk, the voice resounding here, so it's a government program. So goodbye grass corporation. Okay? So that's I think it's in your previous chapter and this chapter is a continuation. So just like we see here for Great Crown. Okay. Now I will ask you to review some of the practice material on page 132. There are some short questions. Okay, short questions. Okay, from 1 through 15. These are also short questions. For example, let me show you this. You have that. Let me show you. These are the short questions. Okay, answer to the questions. I think that will help you develop the concept very, very well. Do it up to right up to page 15. Okay, right up to 15. Alright? Right up to 15. 1 to 15. Very small question, but it's a kind of hint that will help you understand this concept well. It's a very nicely written, okay, and that will help. It covers almost everything which I discussed, but it's a very nice tone. Do this. Now, here is the thing. Let's talk about this. Two things that I want to discuss here. Very important. Try to understand. Don't talk. Okay? Page 140. Page 140. Don't talk to each other. Just listen to me. Page 140. Exercise 3.3 and 3.4. Two things. Identifying accrual basis revenue and identifying accrual basis expenses. Okay, so let's take a look at this. According to the revenue principle, revenues should be recognized when they are, which happens when the company performs X promised to the customer.
140.
Hello, what happens? Okay. For most businesses, this condition is met at the point of delivery of goods or services, right? At the second point, sometimes revenue is recognized over a period of time. That's a different thing. Point of delivery recognition system. The following transaction occurred in September. Now you have to identify whether the revenue should be recognized in the month of September, because this is the September situation, right? If revenue is not to be recognized, explain why, right? Why? The following transactions occurred in September. Gilligan Enterprises issued $26 million in new common shares. Now, this is not revenue, right? This is not revenue. So you'll say, no, this is not revenue. This is the issue of shares. This is a financing transaction. The company is issuing shares and receiving cash. Then it says Western University as a university, fictitious name, receives $20 million cash for 50,000 5-game season football tickets. None of the games have been played. None of the games have been played. Okay? So, what are you going to do? What's the nature of this receipt? $20 million receipt at the beginning of the season. So what's the nature of this account? Say it again, completed? Deferred revenue. Season has not yet been started. So again, the season ticket is very common. When you have to buy a season ticket, you get it a little bit
3.3.
Price, but that's good. The 5 game and the total number of tickets 80,000. Now, here's the thing. It says Western University plays the first football game referred to in here. So once the first game
দেখে
is
আসতে
over,
বলছিল
it will recognize 1/5 of that, right? As a revenue. Make sense?
3.3.
So it will recognize $4 million out of 20 million.
I'm searching, I can't find it.
Then it says, Harwood Construction Company signs a contract with a customer for the construction of a new $500,000 warehouse to be started in October. At the signing, Harwood receives a check for $50,000 as a deposit to be applied against amounts earned during the first phase of construction. Answer from Harwood's standpoint. So,
It's one in my book. It's 160 page.
it will engage in this construction project.
It's page
And it
160.
receives an advance from the customer. What is it?
E33.
Deferred revenue, right? Revenue received in advance, that's a liability, $50,000.
160 to the
Not a part of revenue yet.
160
A popular
E33.
snowboarding magazine company here receives a total
Jaina
of $100 from
edition
subscribers.
different. Okay, bye.
The subscriptions begin in the next fiscal year, which is after September 30th. Answer from the magazine company standpoint, right? Magazine company standpoint. Again, the same thing, it received $1,800 from the subscribers in advance of the year, right? In advance of the next fiscal year. So it's a deferred revenue, it's not a revenue yet. Now, the last one is Fido sells a $100 cell phone plan for service in September to a customer who charges the cell on his credit card. Answer from the standpoint of Fido. What is that? Number 8. Cell phone plan,
Daily
cell
sale.
phone plan for service $100 in September to a customer who charges
The
the cell on
service
his
is
credit card. It's a cash sale, right? It's a revenue.
Defer.
It's a revenue in that month from the cell phone company standpoint. Now, this is a kind of some of the example. You can review E2 as well. Sorry, 3.2, identifying accrual basis revenue. That's also will be very helpful for you. Now, the other one is identifying accrual basis expenses. Example 3.4, exercise 3.4. The next one. Let's take a look. This is expenses, okay? Under accrual basis accounting, expenses are recognized when incurred, which means the activity giving rise to the expense has occurred, right? Assume the following transactions occurred in January. Gateway pays its computer service technician $90,000 in salary for work done in January. Answer from Gateway's standpoint. Okay? Gateway standpoint, what should be the answer? Right? Because you said requirement is required, each of the transactions, if an expense should be recognized in January, indicate the amount. If an expense is not to be recognized in January, indicate why, right? Here, $90,000 paid to a technician for the work done in January. So it must be recognized, right, as an expense. In the month of January, that's a salary or wages expense for the month of January. Then at the beginning of January, Town Bolt Construction Company pays $4,500 in rent for February to April. What is that? Tell me. In January, right? Town Bolt Construction Company pays $4,500 in rent for February to April. Prepaid rent, right? Okay. Assume that McGraw Hill Education, publisher of this textbook, right, uses $1,000 worth of electricity and natural gas in January, for which it has not yet been billed. It has not yet been billed, but it has incurred $100,000 for utilities, right? It's an expense, right? Utilities expense. On the other side, you must create a liability account because the bill is going to come. You have to pay, right? Cooler company receives and pays in January $1,500 invoice from a consulting firm for services received in January. It's a simple thing. It's a consulting service, $1,500 for the month of January. The campus bookstore receives consulting services at a cost of $5,000. I can indicate that payment is due within 30 days of the consultation. That's because it receives the consulting service, definitely this is a consulting fee, that's an expense for the month of January. It's an outstanding expense, right? So create a liability account. And and then Scotcher beach. Why they are using this kind of difficult names, Scotcher beach? I will write X and X. Okay, it doesn't matter. The name doesn't matter. So why would you use difficult names which I can pronounce? Right? Doesn't make any sense to me. Anyway, Scotcher Beach Incorporated has its delivery van repaired in January for $280 and charges the amount on account. Right? It's an on account, so it's outstanding, but it's a repair work. $280, that's an expensive amount. But on the other side, it's a liability. So always remember before I finish it. So you also review exercise 3.5, the next one, you will find annual basis expenses. You can review exercise 3.11 and 3.12. And then you go to review problem PA 3.2 and 3.3. I think
Sorry?
that will be
3.2?
enough for you.
Problem.
Now,
Problem.
before I finish, always remember that when we create deferred revenue, the graduate secretary Lisa Power left.
I think cost problem.
You know that? Graduate secretary Lisa Power.
Yeah.
She left. I just received an email.
Who left?
Lisa Power.
Because I sent out an email
How did you know?
about
I didn't have any.
the next person who will be that person. I will check my email, so they answer already.
But I thought you said she said.
Okay.
Why not that?
So therefore,
I think she left early.
Approve revenue. Okay, and prepaid expense. And accrued expense. That is outstanding. Okay, these are the four things. I talk about that and I'll just look in the next case. Think about this, and those will be in chapter 4. And I think we are in good shape right now at this moment, because in 2 lectures, pretty much I have brought you to that point, okay, where you will be able to understand after that what will be the necessary or critical adjustments that you make relative to the income statement and the current test of activities. So this will be done in 21st we have tomorrow. I'll see you then. Okay?